So, very good evening, everybody. Obviously, it can't be any better than day when we have seen the sentiments has changed completely, because we have seen last many months, people were slightly irritated, disturbed, because the deal was not happening. And a lot of expectation was in multiple times the confidence got eroded. So let's start with the positive outlook. That's a good day to begin. So I just want to talk about uh, in terms of our macro outlook for 2026, so I will briefly covering about the global picture. Then we'll talk about the Indian outlook, and we briefly also cover what changes we are making in the portfolio, what we have made, and how we are looking for end of 2026 in terms of portfolio positioning. Okay. Now let's start. So when we talk about geopolitics, this is one of my most favorite topic, and it's very important to understand because we still believe that 2026, uh, the geopolitical volatility will still remain elevated from a longer term perspective. Why I just want to briefly discuss some these things is very important because a lot of narrative gets built and people are confused what is happening on the Venezuela front or China front or Russia related themes. So let me give you perspective. See, when we're talking about from a geopolitical perspective, this the entire last 5 or 7 years we have seen particularly a supremacy battle between US and China. And obviously these are two important countries which are fighting on a larger resources also. And obviously it has its own impact on the other countries. The crux of the matter is all about how whether dollar will remain a reserve currency from long term perspective or not. And this is the entire thesis, whatever geopolitical develop you are seeing is largely revolving around dollar relevance. So let's talk about for a few minutes in 2022 also when Russia attacked Ukraine. It was a very regional centric episode, but you have seen gradually US came into picture in a big way. Now the US interference was not very relevant purely from a battle perspective, but it was very relevant from a dollar perspective. That's the time dollar was correcting from DXY from 92 levels significantly. Anything drop below 90 could have impacted the credibility of US because the relevance of dollar could have been lost at that stage itself. Now that obviously this is one of the reasons which you have seen the noise. Very recently also we have seen the noise on the Venezuela front also, where a lot of people saying Trump is a very different character. He can do anything like this. But I think it's not about capturing a country. It's all about Venezuela being one of the largest reserve of oil. They were doing large business with China in local currency, with the yuan itself, and that is something which US never wants. Even you recollect the petrodollar things which we people talk about, that 50 years agreement got lapsed, if I'm not wrong, last October or so. So obviously US is looking for a thought process where they want to have a say on global market, and through everything has to be traded in the dollar terms. And even if you recollect uh, trade related challenges that India was facing, India was supposed to get this deal which signed yesterday in the month of May 2024 itself, but it got delayed. And if you go back in the history, you talk about if that's a time BRICS summit was happening and the noise happened on the currency front. And this year, India is leading that. So, what is very important, the moment he got the fear that a lot of BRICS countries are coming together and the dollar relevance can get lost, that's the time he started taking hard stand against the BRIC countries. Obviously, Russia was one of them. Was the important one. He could not do much with China. So obviously, we have seen a far bigger impact on India. I'm just giving you perspective to understand because a lot of people saying it's a ego battle or other things. No, it's a dollar relevance thing is there. And what is very unique, which we have seen in India now, though we went through a very difficult phase in last many quarters or so, I think India remain a very strong of in a very firm approach. The way China demonstrated against US, something similar India also demonstrated. So we have seen some amount of pain, but that's the reason our EU deal which happened, it happened with much liberal because the background was US. And the moment EU deal was signed, US deal also happened. So that's a pressure which worked. If you ask me, irrespective of the criticism which we have faced and the impact on the market, it's a good strategy which has worked in our favor. So I like now I'll come back to the outlook part, just giving you some background where US being a strong force can demonstrate by language or strong gestures, where China, in a very subtle manner, look at how smartly they have entered into South African countries, South American countries, and across the globe. They virtually control 70% of the commodities in terms of price. They have a say. So it's a very important thing how China playing a very different role, very subtle role, and trying to control important asset globally, and that's the way we see the relevance of US is going to decline significantly. And I we talked about in our previous big how 2025 onwards that is cycle will the decay of that process will start in a big way. Now let's come back to the market perspective. So 2026, we are talking about a very highly dynamic and adaptive asset allocation thesis will play because it's going to be again a very hyper activity will be there on the geopolitical front, and you will see multiple asset classes, particularly on the precious metal also, which I'm going to talk about the next few minutes, is going to be equally volatile. Now let's talk about from a global perspective, from a what is the known risk or unknown risk or perceived risk. Obviously, geopolitical volatility will remain elevated. That's the first thing. Now I'm trying to address few important thing, inflation, because has been a challenging right from 2020 onwards. We have seen global inflation has moved up, and with the interest rate also has moved up. Now our view is that the effort which central banks are taking, like not only India, globally, we are in cyclical downtrend. Can it last for a few more quarter? Answer is yes. But we are in structured bull run. So it's a mega uptrend which we are doing. And I think cycle can go up to even 2030, 32 also. So which means we should be mentally prepared for a global inflation period. And it's not going to spike immediately, but it's a gradual uptrend is there. And something similarly, if I have to interfere from a conclude from a current from the yields perspective, both 10-year yields, not only in globally. If you ask me, let's talk about US for a few minutes. We expect it is an uptrend and structured bull run. Our forecast is even we will not be surprised to see 9% also by 2030 or so. So that's the way we look at. So we are trying to look at both from a near and medium term perspective and also trying to give you a larger perspective. Now, coming back to the currency front, DXY, when we talk about dollar relevance, which is slightly getting lost, and last 1 year particularly, we have seen extraordinary hype about this de-dollarization thesis, and every strategist in the world believe that reversal process has already begun. We are not discounting that. We are also very early, right from 2018, we have been talking about. I still believe that we are in structural downtrend for dollar against global currencies, but we are in cyclical up move. And if you ask me, this is one of the biggest perceived risks which is visible to me. The dollar index can spike. That's the one risk which you like to watch very closely in 2026, how it unfolds. So you have to keep back of the mind. Don't look everything from USD INR perspective. The moment I say dollar, everybody say UNSD. I know. I'll talk about UNSD separately, but more from a dollar against G6, G7 country or G6 countries versus in the emerging market also. Now, another important player in the global market is about the because of carry trade, the USD JPY pair. This is a very important thesis. If you've seen very recently, it has appreciated sharply from 160 nearly to 154 level or so. And that's the reason global market we have seen a knee-jerk reaction also. That is the another area of discomfort which I have. Long term, we believe USD and ID is heading, USD JPY is heading for a sharp devaluation. In 2018, we talked about when it was soaring around 104 that it has potential to depreciate 50%. And we have seen by 2025, it was depreciated 50%. Our long-term forecast is even 250 or 275. But from a very near and medium-term perspective, we believe USD JPY or yen has a potential to appreciate against dollar. And that will not going to be a good news for the global equity. So this is apart from dollar indexing, we have to watch USD JPY very closely, how it plays out. And emerging market currency has potential to get devalued. And since we already have been affected, I will cover USD INR separately. So we should also watch USD INR also, how Chinese RMB will going to play a important role. That's an important trend to watch. Now, coming back to precious metal, beginning 2026 on multiple forum, I have showcased that this year will be extraordinary volatility. There's a separate slide which I'm going to cover precious metal. On crypto, particularly, it has been very volatile asset class. I think the similar volatility will continue. I will not be surprised to see a new high, new low in crypto, but gradually with stable coins coming to picture and alternative getting emerged, the relevance of crypto will start declining. So it's an important observation. It's not something got is getting over an immediate basis. Maybe the crypto can have impact, but blockchain as a technology will remain for longer term perspective, and rest of the central banks are adopting purely from a safety perspective. Now, crude also, we expecting that crude will also has volatility, will remain slightly more volatile. We have been seeing very quiet crude for a while, and I am not going to rule out a spike coming in 2020, first quarter of 2026. We have recently seen a one spike, small correction. I'm not going to rule out another spike in the first quarter of 2026. Now, talking about global equities, which we'll be covering in next slide, we are talking about the most important observation is that global risk appetite has started peaking out. And we believe this cycle, the shrinkage cycle, will get activated in 2026, has already started happening. And which means if global risk appetite peaks out, which is again not a great news for global equities. Now let's come back to the precious metal space. Now, last year also we talked about that silver will outperform, and we were constructive on this thing. July we downgraded. We talked about 15 to 20% correction. Correction happened very swiftly, not to the timeline which we had expected. It was so fast. And similarly, we expect that this year also silver has potential to outperform, but gaps will be narrowed significantly. We are calling that this year precious metal will behave with a huge volatility, which we have already seen very recently last week. This has been our view since the beginning of 2026, that this year will remind you how precious metal will can behave like a cryptocurrency. So that's a very important thesis. You will see 15-20% sharp move, 8-10% up move, another 20% down move. That's the way this year will play out. Now, if I have to really talk about some ranges, generally I don't give, but since this is such an important asset class where a lot of people have interest in India, our view is that USD in gold in dollar terms, I don't track MCX or the Indian rupee terms because data is very limited. So we are talking about everything in dollar terms. So I expect that 37, 3800 should be the lower side, and upper side you can see 52 to 5500. We have already seen nearly 5500 in the price, and then we saw sharp correction till 44 or something levels. I expect that crude gold has either already peaked out or has a potential to spike in a very near term perspective, and it starts settling down. I still expect some more correction in gold before we get into it. Something similar, we're talking about silver. So we think 55-66 should be the low range, and maybe 170 to 127, which we have seen very recently, should be the upper band. Now, in terms of this is the outlook, what exactly we have done in our portfolio in our multi-asset fund, which has been one of the best performing fund of 2025 in last 1 year perspective. We actually pruned down. We were running nearly recent spike around 24% silver. Before that, it was around 630%. So we have cut down silver significantly before it started correcting, and we shifted towards gold. And that also we have pruned down nearly at 5500 level. Virtually, we got the exact top in gold on 29. We pruned down our exposure. So currently, we are running with the minimum 10% requirement by the SID, and hence our exposure has cut down drastically in our multi-asset fund. And at appropriate time, we will be rebuilding that position. I said we are not negative on the sector, but it's going to be very volatile. So real challenge comes how well we can capitalize these short-term and medium-term opportunities which will emerge in 2026. But if I have to say with little bit of confidence, I can say we have already seen the peak of silver, okay, and gold, both of 2026. Very unlikely that you will see these prices crossing again in 2026. That's a larger call, but definitely we are not negative on an asset class. We have been saying for last many years it will be core portfolio. So the core portfolio thesis continue. That's an important observation on the silver side. Now, coming back to very quickly on the currency, briefly, I have already covered. So only two currencies which we think have an impact on the global perspective. Swiss franc has been a very safe haven. We still expect that this is the one currency which can appreciate in the beginning of 2026 against dollar. USD JPY is another one. But I do expect by end of 2026, the Swiss franc also will become very volatile. If I have to extend the thesis of dollar, which I talked about for a while, now that we have seen Venezuela related crisis. If you ask me what exactly we are looking in terms of both dollar perspective and crude perspective, and if I have to talk about market implied analytics, my next thing is that the next crisis is in the Nigeria, because Nigeria is also very large reserve. Some disturbance is already started, and I think given the geopolitical narrative which I was explaining, the next big crisis is unfolding in Nigeria. And then, if you ask me, we have seen some of the Brazil currency, particularly, has appreciated a lot. I think if you ask me from a brisk perspective, we have largely settled the scores with US now. I'm not saying on a long-term basis, but at least from a temporary perspective. I'm worried about the Brazil currency also, which has a potential to depreciate sharply in next few years. So couple of BRICS countries currency depreciation is on the cards. So the thesis which I talked about in the beginning of the presentation, dollar index is a risk. Dollar is something which is very important. US to what USD JPY very closely. And anything you observe can lead to a turmoil in 2026. A very important observation which I want to highlight. Now let's talk about global equity outlook before we come to India. Last many years, particularly last few years, we have seen the P expansion. Apart from earning expansion, P has expanded significantly for global equity, particularly in the US market. And in the last few months, we have seen something similar trend in the emerging market. Look at the how Korea has spiked sharply, though it corrected yesterday and again spiked today. So we have seen all emerging market up move happening, including that starting with China and then move to Taiwan or any other country. If you look at India is the only country which has not only underperform against the developed market, but also against the emerging market. So we are calling it uh, not a bubble sort of thing which is getting built in AI. A lot of people look at. We think we are seeing a extreme level of euphoria which is getting built in the global equity. Global markets and market participants are very, very complacent. So we are seeing corn complacency indicator is one of the highest level, and hence it means that vulnerability of US market, vulnerability of some of the regional market is on the cards. And that is something which you have to keep back of the mind. Suddenly you realize, like yesterday, Kospi was down last week, Jakarta was down 17, 18%, Indonesia. Okay, so it's some area which you have to keep in mind. They have virtually moved up sharply. What you have seen happening in China, in silver and gold. Something similar happened in Jakarta also. It's very important to keep this aspect in mind, and hence we are calling it a P contraction phase. Globally, the P contraction will phase has already begun, which means all the AI related company or Magnificent Seven companies, according to me, they have already peaked out or their crest is about to be formed. And this is one of the reasons we are saying that with this thesis, value thesis will outperform the growth. And this is a very important conclusion that the P contraction, which means extraordinary high stock where P multiples are extraordinary, those are very, very vulnerable. So this is the small thesis, and obviously DM risk appetite is also started shrinking, which is not a great news for global equities. Now let's come to India piece. So we are calling India could be outlier in 2026. We are very clear that India will outperform both EM and DM. And let's understand what is the thesis for that. Okay. After giving a slightly disturbing picture of global equities, India looks pretty safe. Now I have not used the word absolute outperformance begins. I have starting to say that it's a relative outperformance begin. Couple of reasons which I believe. As we know, India has been very expensive as compared to DM and emerging market. Despite sharp correction, our P multiple has not contracted up to that extent what as compared to other developed market. And our thesis is that we always say that India perception has changed purely from perception analytics perspective. India P multiple will remain elevated from longer term perspective, and our longer term perspective is 2047 50 levels. So which means we have to live with some amount of overvaluation on a relative basis. Now, we believe India is the best growth story in the world. I call it structured bullrun, which is playing out. And if you really look at him from a GDP, nominal GDP perspective, the best compounding story, which is we have seen the growth outlook is more than the double, okay, which is a clear indication and multiple data points which we can talk about. So obviously, from a macro perspective, we are in a better position. And what we are talking about, the despite that P contraction thesis for global equities, I think India P is now close to historical average. We believe that, and I said in the beginning, it will never going to correct so sharply. So this is the area where we believe that is large parts of the correction has been priced in. Valuations have corrected a lot, and now they are much aligned with our macro, which also means it has a potential on the upside. Now, if you very important, we look at when you talk about crude perspective, India's total export over the forex we pay to buy the crude in last 18 years or so. If I look at the 2008 crisis, from there I have looked at this ratio has come down significantly, which means even the current weakness which is there in the not only we bought from Russia, that's the cheapest thing, but overall crude prices are still weak. We are the biggest beneficiary where our GDP from 1 trillion has gone to $4 trillion, and our energy bill has not exceeded up to that extent. And maybe next few years we go to 7 or 8 trillion dollars, and this ratio will keep on declining. And that's the reason I'm saying from 2032 onwards, India growth will be the perception will be very different. And one of the reason I believe that India rupee should appreciate in the next 6 years. This is something I'm going to talk in next slide. So unexpected support came from RBI in terms of liquidity. If you really ask me, this is one debate I've been saying for a while. In our previous book, also, we have written that by 2025, rupee will be at 90. We have seen closer to 92 marks on the USD INR pair. We think this cycle has either peaked out or in the final stages of peaking out, which means the probability, and again, when we talk about predictive analytics is all about probabilistic sign, not deterministic sign. So we never say this is going to happen. The probability is that we have already seen the depreciation cycle peaking out. I'm not saying the exact levels. What is very important, the depreciation is everybody used to take 3, 5%, 8% depreciation on a year basis. I think that cycle is peaking out. And India, given the macro picture which talked about, has potential to recover irrespective of our call on dollar and irrespective of call on the global equities. USD IR pair should be in a better position, and today's move also endorses that thesis. Once this picture or the uncertainty settled down, rupee has potential to appreciate. The moment rupee stabilized, started moving up, both FPI and FDI flow will also increase. And because we have seen good amount of selling exhaustion happening in the FI front, most of the long account, the selling which we have seen has actually reduced significantly. Now what we are seeing is largely coming from the passive side. And the pressure which we saw last week was also more from a passive perspective because emerging market under pressure. So it's bound to happen with subcurrent. But India pie has actually reduced in the overall emerging market. Recent deal with EU is much more liberal, I said, than they expected. We are very clear. We have been talking about that earning cycles should ideally bottom out in September, and since then it has moved up. So we are believing that the revision cycle will gather momentum, and the structure change which we have seen more from the this GST perspective or the income tax perspective or even RBI liquidity will support the our earnings cycle. So this is the most larger perspective which we're talking about India. Now let's look at from a let me spend few minutes on this deal which happened. Now obviously from 50% to 18% looks very nice. But what is very important to understand how exactly it play out, because nobody has seen the final printouts or the detail because not been disclosed. Whatever little bit of analysis we have done, we think this number should be even lower than 18%, maybe average should be closer to 14%. And hence is one of the good deal which we have. And the noise which was there on the agri side, we believe is only for the crude, only for the corn they will take it, because largely from the generating electricity out of that or something on the fuel perspective, they will do it. Otherwise, it's a good transaction which has happened, though we have suffered. And if you also materialize, let's say next few months, then we are talking about a very sizable export opportunity. And we believe that in next 6 months, few more countries, whether you're talking about Canada, whether you're talking about Brazil, Australia, many such FTA are in the bilateral talks are going on. So if you really look at, we saw one crisis and the way government has handled, and our commerce ministry was traveling across the globe. I'm very optimistic from a longer term perspective. It's a step in right direction, which not only support the rupee also, but it will change the image also in a big way. And let's say even let's say rupee has depreciated, maybe I will say as a part of a strategy when you were suffering on other fronts, you let allow rupee to depreciate, which has managed the export momentum and is not impacted. So it's a good news. So obviously, I'm not getting into more detail. Let's wait for more details. Now let's come back to the uh, near-term outlook perspective. Okay. Now, when we talk about relative outperformance begin, what we are talking about here, we are seeing early signs of vulnerability, particularly in the IPO market, because the way we have seen AI bubble happening, or I'll not use the word bubble, I will say it's euphoria which has happened in the developed market, particularly US market, Taiwan market, and China market. I think there are extraordinary complacency was there. Something similar feel we get from our data in the IPO market. That is the one area of most disturbing for us. And I think here you can see maximum amount of pain in 2026 and onward also for next 3 years. I see this is the vulnerable area. And when we talk about P contraction, the P expansion only happened in new age companies in a good way. India P has not expanded for the old economy stocks. So area of concern. Now we have been always highlighting right from July 2024 that easy phase of bull run got over and we are in bull run. Very important. A lot of people get come and ask is that bull run is over or what? No, we are in difficult phase of bull run because as I explained you, we are India is a structured bull run from longer term perspective. It's a structured story which is playing out. So from a very near term perspective, we might have some challenges, but we are still in bull run. So difficult phase of bull run can be managed with the help of stock rotation, sector rotation, and how well you effectively have agility in managing the portfolio. Now, given the background which we are seeing from the vulnerability on the global market, vulnerability on the currency front, and the extreme volatility on the precious space on the commodities market, our priority is focus on the liquidity is very important role to play. So the entire portfolio is this focus is a lot on the liquidity aspect, not from the redemption perspective. It's a psychological number and it gives you comfort. And we are very clear. This is a thesis of relative outperformance. We talk about the P contraction for global. The value stock will outperform growth. And obviously, we have to identify within the value territory which are the growth stocks. So India risk appetite cycle which has been shrink a lot. We think it is now coming closer to bottom, and I expect maybe by March that cycle should end, which means the beginning second quarter of 2026, you will see a very sharp rally in the equity market because risk appetite data is something which we walk very closely, and we are seeing some signs of reversal. but we expect maybe by March end, maybe April, we will give you more perspective on that, which means second quarter onwards, a decisive move can begin, and maybe next 1.5 months, market gets into consolidation phase. And if you really look at today, also market rallied sharply. So I was saying in one of the presentation whether how to read the market. This market has rallied 600 from the yesterday's closing, or I say market has corrected 600 point from the top. So it's up to us, a relative call we have to understand. But what is very important, this deal has changed the sentiment. The drive is back. Energy levels are back. People who have given up. Market has not corrected in India on a big sell-off. Market has corrected because of lack of buying. Because everybody has become, they were all went into shell sort of thing. People were not participating. And for reason we talked about liquidity was will going to play a very important role. It's not like everybody is out of the shell and everybody is very excited. We will also watch very closely. But what we have gathered while talking to the various brokerage from the flows has been slightly more positive today. Let's see the final number. I think this this news will act as a trigger because people have given up on India. Now, if global market corrects sharply, then this is a great news for India because India has already underperformed and we have a negative correlation with the developed market, both developed market as well as emerging market. So if global market corrects sharply and whatever reason, India can also has impact from a very sentiment perspective. But our view is that India will be the first market to recover after the correction. If there's a bigger crisis on USD, JPY, and other front, but we are more optimistic about India because this important trigger is a psychological comfort. It's not like something will change overnight. Most of the industry has already accepted, and the difficult phase of the market is largely over. It was a big psychological relief which we got today. So again, new age company, we have concern value will outperform. We are very clearly looking at if data center is a large opportunity, then energy is a very important thesis. We talked about how earlier we used to talk about Hindustan Copper as a copper because instead of playing EV, you can play through copper route. So large infra, data center, AI implementer, where a lot of people believe India has missed out that opportunity. Answer is yes. But I think it's not about just AI missing opportunity. Somebody has to implement these things. So AI implementer will play a very important role. And a lot many our tech companies are molding themselves for this opportunity. So anything which is related to AI implementation should be a thesis. Generic on the pharma side. Media, not big sector, but again, very neglected. Entertainment, hotels. These are the spaces which we like, and on anything which is on the relatively underowned, undervalued, and neglected territory stock should be the focus area. Now, let's understand this is what the thesis which we are building. So, a lot of people have asked this question in the beginning of 2025 when market has corrected, how the end of 2026 would be, 25 would be. I also said that it will be sharply higher than closing of December 2024, which did, and we saw a new lifetime high. I expect something similar that second quarter onwards, market has potential to revive sharply. And maybe by end of 2026, December 2026, India will close in green. The opportunity will not be very meaningful. It will be reasonably good. And you have to take advantage of sector rotation and stock. So we are actually entering into 2026 with much more conviction than what we entered into January 2025, because that's the time correction has just begun. Now we believe either correction has already happened or we are in the final stages of that. And hence, I will play this opportunity to go long on the market. And that's the reason if you really look at a market open today, we as a one fund house were large except in our mid cap and one our portfolio where we have 8-10% cash. Otherwise, most of the portfolio we entered into this event with 98 to 99% deployment. So it gives you clarity that when opportunity comes, it should not happen that you are not there. Now let's look at in terms of some of the changes which we made. So last year, particularly last 1 year, we talked about our mid-cap portfolio relatively underperformed the market, and we have reviewed a lot of our changes we have made. And this is some of the with the big macro picture we talked about, and we also talked about how the environment would be and what type of sector we're looking at. So we have done a major revamp exercise on the portfolio in last many months, and we believe is 90% that exercise is over, maybe by end of March 2026. Remaining 10%. The 10% is not very meaningful when you're talking about large portfolios. We as a house have never added large private sector banks in the past, but this time we have cut down our PSU exposure and we have gone overboard on large private sector banks, and we are significantly weight our portfolio is has weightages on the private sector bank. We also believe, excuse me, yeah. The insurance sector also has been trading in a neglected territory, very large sector. Some headwind was there on the sector side. I think that also has been largely addressed. So this is another big opportunity we are seeing that in insurance side, whether it's a general or life insurance side, insurance sector in general, we have increased lot many private sector insurance stocks we have built in our portfolio. We have cut down real estate when the market get corrected. The biggest damage obviously happened on the premium real estate side because a majority of these places are uh, built or purchased with the money largely coming from the equity market when they suffer. And so we are not negative on the real estate as a whole thing, but purely from a positioning point of view, risk point of view, we have pruned down. We have cut down PSU banks, I explained. We have increased some exposure in select pharma, particularly on the generic side. Insurance is on a thesis which I've already discussed, it's just a repetition. We have also increased our exposure in the FMCG and consumption names post this GST. Now, we believe that the real impact you will start feeling in from the beginning of January itself, because inventory related challenges and the trade related challenges which is there because of these changes, I think largely behind us. So that's the one area which thing we have also rebuilding some of the exposure in mid and small, because after the recent fall, some of these names have been very attractive. So if I have to really conclude how to play 2026, one clear opportunity is obviously multi-asset fund, which I have talked in the past. That's the one big opportunity because in 2026 also I see volatility in various asset class. That should be a good opportunity. Within flexi cap should be another good opportunity. And even the low risk portfolio like BAF, like we run a DAF type of portfolio. Okay, it should be a good opportunity. So I think we don't want to run a very skewed portfolio in terms of risk profiling. We want to run relatively low beta names in our portfolio. We want to run like a more defensive approach, but with a growth opportunity. When we're talking about defensive thing, we are not saying that market is going to correct and hence I'm parking money here. No, we just want to play safe. And these are the names, whether you talk about private sector bank, they have not gone anywhere. Insurance have not gone anywhere. So there are opportunity which we are trying to identify in the larger market, liquid market, and that is the one important criteria which we are looking at. So we are very constructive on Indian equity relative to global market. See, everything like somebody asked this question about budget. I said budget was very good. If you look at an absolute pure budget was very good. But on relative basis, what market was expecting, there was a disappointment. So what we have to look at both absolute and relative. So relative basis, because money shift on relative basis. And globally, we are in a better position to capitalize this opportunity. I expect that with a lag effect of 1.5 months, I see good amount of FPI flow coming to India because we have seen exhaustion, and hence anything which is completely beaten down, very attractive, should be opportunity. This is the year will make big difference in India from a global perspective. So I'm remaining very constructive in terms of equity positioning of the portfolio. Yes, safety liquidity is an important background. Given the background which we're talking about, volatility in the asset classes and particularly in the currency front. So I will stop it here. I'll ask Anupam to open the floor for question answer sessions.
Thanks, Sandeep. I
Yeah.
think you have covered many things, and I have couple of questions more from the perspective that whatever recent changes we have done in our portfolio,
Hmm.
so by when we can, have some changes being reflect scheme by scheme. So maybe if you can broadly tell that if you whatever changes you have done, by when we can see some, it can reflect in the performance of the key schemes, like let's say multi cap and maybe
Yeah.
the flexi cap fund.
Okay. So, Anupam, as I explained, ki we have made all these changes, and it's a gradual thing which happened. And you see, let's say if you talk about today's move, we think we should be the biggest outperformer in today's environment. The way our portfolio was positioned, we should be taking the advantage. But I'm not just looking from one day perspective. What is very important to see how this 2026 year would be, and keeping the global risk which we talked about, how well we can protect our portfolio and not to miss an opportunity. And that's the way this portfolio revamp exercise has happened. And as I said, now we have started using a lot of high frequency analytic also, which is going to help us. Because see, today what is happening in the market, let's understand, you are fighting and competing with machines. Okay, it's the results are good, stock can be up 5%, results are marginally bad, stock can be down 5%. So 5-10% becomes a norm. So we have to very clearly understand up to what extent what is priced in, up to what extent price is not priced in. And that is something which is not easy. And that's the reason I said we are also strengthening some of these analytics to capture, because market has become very short term. The people tend to overreact on both the sides because the depth of the market is missing. Maybe I'm hopeful that after today's this positive news, the activity level in the market will improve. So if I have to really conclude from perspective, it's a gradual process. We have made changes. We are in a very comfort. If you ask me, our portfolio is very, very safe. If you look at, and if you also notice, now we have started making the last 2 months, we have started writing in this fact sheet also. We have written what changes we have made in our portfolio, the scheme specific changes we have started highlighting. And next 2-3 months, maybe by April also, you will see more analytics coming on the portfolio disclosure perspective. The thesis, I will not say what exactly the thesis, but some of the changes happening, and with a broader perspective, why we made these changes will be part of a fact sheet strategy. So it will be help me in a more transparency, and people should get a perspective, some of the changes which we are making, and how, and I'm sure you will see the impact in a positive manner.
Sandeep, maybe at the risk of repeating, because I have so many questions on the performance, so I will take one by one few questions. So maybe a question by Pawan Ghavri. Actually, he wants to understand what is the insight on the mid cap fund. Maybe what went wrong in the recent past and way forward to return its glorious day in 2026. This is Pawan from Pawan Ghavri. It's a
Okay.
mid cap fund.
So I said since some of the exposure which we took on the mid-cap names we talk about, which is more skewed towards some of the PSU stocks, and some of the names which have not performed up to that extent. Apart from that, the real challenge was that some of the outliers, which was there in the mid cap, who was a real contributor in the mid cap index, we didn't have in our portfolio. Okay. As I said, we have been very skeptical about the new age company. We generally don't participate. And that's why in last 1.5 or 2 years, they have done extremely well, whether we like it or not. But that's the fact of life. They've done anything. And that participation, which we have not done, has also affected us in a big way. So our stocks have underperformed, and B, the opportunity which we were not able to capitalize. So two factors for that. That's the reason we did our own analysis. We talked about our real underperformance was on the mid caps names, not on the large cap, not on the small cap, predominantly in the mid cap space.
Yeah. Thanks, Sandeep. Our next question is from Senthil, and the question is: if an active fund is performing below benchmark for a considerable time, say 8 quarters, so how to address such queries, especially with the HNIs or the retail investors? So, as usual, Sandeep, I have spoken to Senthil, and we have discussed that money is there for 4 to 5 years, so that's a phase. But once again, if you can take this query in your way.
Okay, so we let's understand how we operate. Okay, it's very important from a perspective when we talk about obviously when everybody coming to the equity market is 5-10 years perspective we look at. We always say in a risk on period, we try to generate an extraordinary alpha, which help us in protect in a downside. Okay. So that's the approach which you are following. If you really look at even this, let's say last 1 year of underperformance, if you look at 5 year perspective, most of the schemes has done extremely well. So what we have to look at is that even you, the challenge which has come with a lot of people who came in the peak of the 2024 cycle with us, those have been suffered the maximum. What is very key to understand is that how we approach. We are very vocal about our failures also. We always say that VLRT framework has been built on failures. It's not like a success story. So we keep on modifying, we can make changes. We understood what went wrong, what is the reason we talked about, what changes we made in our portfolio. I'm not getting into the details, but I'm just giving perspective. It's a mathematical way of running a show. We don't run work on a gut feeling basis. We don't think this is what we like, this we don't hate it. Something which we try to evolve, and it's a continuous process. So we are really optimistic that it will change. And I said we have revamped our portfolio. You will see a gradual change in many schemes. That change is already visible, and some of these schemes which is not visible, particularly in the mid cap heavy in schemes which we talked about, you will also will see in a phased manner.
Thanks, Sandeep. Next question is from Dollar Shah. He has two queries. One on the performance. I think you have already addressed that in a way. And second is you have, as per recent budget, real estate and infra should do good. However, you have done some changes and you have reduced your exposure in the real estate and infra. So, what is your take on that?
No, no, we have not increased our exposure in infra. We have only reduced in the real estate name. Infra, we are remaining. So let's say example, L&T has been our top holding in most of the scheme. It will remain as it is. We have not made any changes on the thing. And some of the names which we are holding on infra, they have actually corrected a lot, but we see a value there. We see opportunity because last 1 year has been a challenging phase for the industry from a working capital perspective. Government order was slow, payment was not happening. So entire industry has suffered, but larger interest, we remain very constructive on this space. And I think even the current budget also has very reasonable large amount of capex for things. So I don't see a challenge out there. But I said that anything which is becoming too expensive, too overowned, those are the names which you have to avoid. We have made some changes, but not extraordinary changes like we have sold out infra names. No, not at all. Rather, we will looking for rebuilding some of the exposure in the mid and small space. We already done something, and we will see because those are the area on the infra side also where we have seen the correction was slightly more brutal.
Thanks, Sandeep. Shubhra Deep Bhaumik wants to understand more on the multi-cap fund and what is the reason that the, maybe again the performance and
I just
when
few
you
minutes back, Anupam, we have taken this question. We talked about with anything which is a mid cap centric. So both active and mid cap was the reason for underperformance. We just, I think, few minutes back only explained that.
correct, Sandeep, but I just want to acknowledge that these are the questions we
Yeah,
are
yeah, which is fair, which is
taking.
very fair, which is
Yeah.
very fair.
And maybe Tejas Desai has asked question on the QSIF equity long short fund. So I know that we are not taking it. So maybe
We will doing in next few days. We'll doing a separate QSIF session. We'll cover all these question on that side.
yeah. Again, Sandeep, there is a question by Viral which says if UGC guidelines come into action and some compromise made on the tariff front, allowing agri products to come into India, this may disturb Modi government. I think this is very political, so we can
No,
avoid
no,
that.
I don't think it's all narrative. Let's not get into it.
So, anything, any views on the tariff side? What has happened with the two deals, though you have covered in that. So, can you throw some light on the specific sectors which can be impacted positively from this European and American deal?
So obviously, this budget also, if you look at, is a very manufacturing-centric budget, which we saw. And obviously, given the rupee weakness and the export opportunity, so I think we should also look at large exporter from this country, whether you talk about auto component, whether you talk about pharma space, whether you talk about heavy engineering, whether you talk about defense up to small extent. Anything related textile is another one big area which has been affected badly, or the food processing company, particularly on the shrimp side, where we have very large export, which has been affected a big time because US was one of the biggest consumer of these products. I think activity has picked up in other parts also. So these are the beneficiary. But today, what we have to see, they have corrected sharply, and obviously some of the stocks were like had open only in the circuit. So most of them, these names which you're looking at talked about, they're largely 16%, 18%, and some of them are even 20% circuit. So I think what is, if you even ignore, let's say, one day or of this surprise up move which we saw, because nobody was expecting this and suddenly this happened, I think sentiments have turned positive. Even a lot of foreigners, they never got an opportunity to and sit down and analyze these things. As I said, the details of the deal is still not in place. As and when that become in public domain, people will do more deep diving and try to conclude. But I'm saying net is a constructive thing. As I said, manufacturing and export centric is the area which budget and economic survey talked about. I think we are also positioning in that sense.
Sandeep, maybe last two questions. Bharat wants to know why generally turnover ratio of quant AMC is much more than other AMCs. And Rusha wants to know whether we are running right now into the risk on scenario or risk off scenario. These are the two questions if you can answer it.
Okay. So, uh, okay, first question was on the turnover. Okay. Okay.
Yeah,
Stock
the
turnover.
turnover, Sandeep, yes.
Okay. So I tell you, as an investor or as a distributor, you should not be worried about the turnover because mutual fund are very tax efficient vehicle. It doesn't impact you. What is important to understand, if any possible rebalancing, I don't call it churn, I call it rebalancing, helps you in diluting your risk or optimizing your opportunity, then the churn or rebalancing is actually good. Globally, it is considered very good that you are real active money manager and able to change your portfolio. In India, this is the myth I always say, because a lot of people have explained if you turn your portfolio high, it means there is no strategy, no clarity. That's not the way. Today, you're fighting with machines and hedge funds. Okay. Now, if you say that this is the way, then you are outdated in the market and it will not be really very relevant. And again, also depending on the philosophy you follow. So, some of the funds people manage like a private equity from a longer term perspective for 10 years, 20-year perspective. Some people manage like majority of the people manage like a quasi passive product where 70, 80% are passive thing, only 20% you have to manage. We manage 100% of the portfolio in a active manner. So one difference. Second, you talked about what was the second question from my slipped from my mind?
We are into a risk on scenario, risk
Yeah.
off scenario, how we are managing that scenarios.
So I will say let's understand from a macro perspective first. Developed market and global economy, we are in entering into a phase what we were in July 2024, which means global equities are risk appetite has peaked out. So we are entering into a risk off period. Okay. We are in the early stages of risk off period, both for the developed market and the select emerging market. In India, we were like we saw in between a small risk appetite, marginal risk appetite talked about, and it corrected further. So India is actually in other side where we are saying that risk appetite should bottom out by March and April onwards. You will see a massive risk on cycle coming back. So we are in the fag end of that cycle.
I think, Sandeep, I don't have
Yeah.
much question. Maybe from one question, what is the Sensex Nifty do you see this year? And if you can answer that, otherwise, I think there is no more questions.
So let's put that on the downside first, As I said in one of the channel I talked about, the downside is not very you forget the last today's move if you ignore also. Downside is not very meaningful, maybe 24,500 or 400 it can come. I don't see any meaningful downside. But what is very important to understand, what is the upside? And upside obviously depends on the how the FI flow, because so far, it has been largely domestic mutual funds and domestic participants have been supporting, and they have absorbed all the FI selling or FPI selling which will happen. What if we are able to see the data correctly? We are saying that FPI selling is largely getting exhausted, or we are in the fat end of it, which means next 1.5 months time, market get into consolidation phase. And from there, a big up move start, because by the time I expect even global market has potential to correct. If they correct, money will shift to India because money shift from high risk to low risk environment where this market has already done extremely well. So people will take off some money in these market and put to Indian market. So I'm optimistic now. Difficult to visualize what will the upside number. I think let's 26,400, where again it came today and then again corrected. Let it cross decisively. But end of the year, we think it will be significantly higher than what the beginning of the 2026.
Thanks, Sandeep. I think there are no more questions and we can conclude this call.
Yeah. Thanks a lot. Okay, Chalo, you guys take care. And idea was we got into today the big macro because lot many people don't understand that, but I still felt to educate you because this is a very important event which is unfolding on the currency front and the asset classes front. It's very important to understand. You don't have to keep everything in mind, but it really helps you in terms of thinking on how India is in a better position globally. That's the reason we thought I'll explain you. Chalo, thanks a lot.